there's so many different inputs that come into my mind as someone who's focused on the Dallas market, as well as a few other tertiary markets within Texas and Oklahoma. But because I am saturated in those markets, I'm around other sponsors, I'm talking to other vendors and people in those markets, I have a lot of market experience, and that weighs heavily on my underwriting and helping me to be accurate. We use a model called the SDA, or the Syndicated Deal Analyzer. And it's a great model. Many people, even outside Michael's ecosystem, use it because it's relatively user-friendly. It has a lot of functionality built within it. But within that model, there's certain assumptions you have to make. And so we went through some of those assumptions, talking about what do you need to consider and how do you go about accurately predicting, or what sources do you find to accurately predict those assumptions. And so the assumptions we looked at were things such as pro forma income, which is simply the income that you're trying to push the property to over time; expenses, the cost associated with running an apartment, which is all the things that your PM needs, or your controllable expenses plus your taxes and insurance; your rent and expense growth. So over time, both rents and expenses associated with running an apartment go up, and we need to model those if we're going to be holding the deal over time. Our terminal or our exit cap rate. This is a huge deal that makes a lot of difference on the results that you see on your deal. And then your debt terms on the property. So unlike residential and commercial real estate, you don't lock in debt terms and then begin searching for a property. You find the property, and then many times, several weeks after that contract is signed, you lock in your debt terms. And so having a mortgage broker on your team to help you figure out what those reasonable debt terms are to model in your underwriting is crucial if you want to be able to meet the projections you have. And so we talked about a number of different sources that we can use in order to come up with these key assumptions. And I've already mentioned one, which is the mortgage broker associated with the debt. But then there's a number of other different sources that we looked at to find the other assumptions that I mentioned. And the first one that should always be at the front of everyone's mind is market experience. And so ultimately, your experience and your focus on a given market will determine a lot of how you do your underwriting. And so there's so many different inputs that come into my mind as someone who's focused on the Dallas market, as well as a few other tertiary markets within Texas and Oklahoma. But because I am saturated in those markets, I'm around other sponsors, I'm talking to other vendors and people in those markets, I have a lot of market experience, and that weighs heavily on my underwriting and helping me to be accurate. And so you don't want to discredit market experience. Another one we talked about was brokers. And so brokers are a wealth of knowledge. Essentially, they spend all day long looking at deals, talking to potential sellers, transacting deals, talking to potential buyers. And all that interaction helps them to be true experts within the market that they're in. And so they can help you with a number of those key assumptions, including income, expenses, cap rates, rent growth, occupancy, and probably a couple others. The important thing to remember with brokers, though, or I should say the two important things to remember, is that number one, they represent the seller and not the buyer. And so they inherently have a bias as someone who's representing the seller. But then secondly, their primary goal is to transact deals. And your primary goal as an investor is to invest in good deals. And sometimes those goals can be in conflict with each other. And so we talked about that while they are a wealth of knowledge, you always want to take what they have to say with a grain of salt. The next item we looked at was data reports. So these are things like CoStar, Yardi, Crexi, services like this that provide data that they gather up that's useful for multifamily investors. And so, we walked through actually some reports from CoStar specifically talking about how those can be used. But one of the things we highlighted is that the data in these reports is only as good as the information that goes in. And so if I have a CoStar report and I'm looking at, say, cap rate data as an example for an area, but there's only been one transaction in that area over the past year, I'm probably not going to get meaningful information about the cap rate on properties because there's a lack of data going in. Likewise, if you're talking to, other data sources, whether it's brokers or property managers, and they are not well versed in that market, you're going to be getting faulty data. And speaking of property managers, they made up another source that we talked about, which was third-party vendors. Likely your property manager is going to be the most useful of those third-party vendors, and they can help you with the normal controllable expenses associated with running a property, accurately predicting those. So these are things like the management fee, the payroll, the advertising, contract services, etc. But then there's other third-party vendors, such as an insurance broker or a tax consultant that can help you with those two specific line items, which have been particularly challenging for multifamily investors over the past couple of years. So we went through all these key assumptions and talked about it. And the one final source at the end that we talked about was comparables and how those can be used to find your pro forma income. And so all the other data sources that we talked about, whether it's property managers, brokers, or data reports, they derive their information about potential income or pro forma income from comparable properties. And so it only makes sense that you as an investor should be doing the same. As you're looking to purchase a property or become an expert in a certain area, take the time to first look at properties online. That's kind of level one. Then call the properties, ask them, what are their rents? What services are provided? What amenities do they have? And then kind of level three, the most detailed level, is to actually go do a property visit as a, secret shopping as a potential tenant and see all the details that you can about that property. Not just the rents, but once again, what amenities they offer. Do they pay for utilities? Do they not? Is their staff friendly and helpful? Do they try to sell you on renting an apartment, or do they just simply give you what you asked for and take no effort to get to know you and gather your information? So all these details are really important as you're looking at comparables. And so I recommend that as being the ultimate source for your pro forma income as you're building it out. So once we have our model all the way built out, in terms of the expenses, the income, the assumptions, the pro forma, we then have to decide how are we going to structure our deal. And there's a number of different things that we look at when structuring deals. We look at the partnership splits between the limited and general partners. So limited partners being the investors in the syndication deal, general partners being the deal sponsors who are facilitating and running the deal. We look at preferred returns. And so if you're not familiar with preferred returns, it's simply the ability of a sponsor to give a certain X percentage of returns entirely to investors. So for example, if you have a deal that has $1 million of investor capital in it, and you're offering a 6% preferred return and you hold that deal for 1 year, the first $60,000 or 6% of returns goes entirely to the investors. And this is kind of a safety stop, if you will, for investors, because it ensures them that the sponsor is going to be working to beat that hurdle and make their profit on the deal. And also in the event that the deal underperforms, the investor is put first when it comes to providing returns back. And so we talked about preferred returns a little bit. Additionally, we talked about structures amongst general partners. And so typically on deals, there's multiple general partners that are playing a role, and those responsibilities vary in their technicality and their difficulty. And so there's a general partnership split amongst the sponsorship team. And so that's something that you have to look at as well when you're talking about the deal structure. And then finally, as we were talking about structuring deals, we mentioned that ultimately it's not your underwriting model that dictates how the deal is structured. It's the legal documents or the operating agreement, both between the LPs and the GPs and between the GP team. And so your SDA or your underwriting tool can have whatever returns, it can have whatever deal structure in it. But if that is not properly communicated and documented in the legal documents, it doesn't exist. And so it's really important to realize that as you're structuring a deal together. And so after that, we talked about some of the common pitfalls that I see from students who are underwriting deals today. And this is really where I think mentorship can be valuable, because you have someone to kind of hold your hand or look over your shoulder and make sure that you're not making some of these mistakes as you're underwriting these multi-million-dollar projects. And the first one, which seems kind of like a duh thing, but it's the incorrect assumptions, okay? And so we talked about all these different key assumptions and, how you can make them, but it still is the most common mistake that I see personally when I'm working with students. They have assumptions that are incorrect. And so, when they do that, you have garbage in the model and then you get garbage out of the model. And so that's the most common mistake that I see amongst students who are underwriting deals. Another one is not modeling pro forma income over time. So say you have a property that currently makes $250,000 a year, and your pro forma says that you can get it up to making $300,000 per year. Sometimes students in their scenarios tab, for people that are familiar with the SDA, they'll put that $300,000, which basically means on the underwriting tool that they are making that higher income from day one. That's incorrect. What you want to do is start with that $250,000, and then on the P&L tab over time, implement that business plan and raise the pro forma up to $300,000 gradually in a manner that your property manager is able to commit to.